So I'm sure by now you've all heard of dividend investing and you know why it's so damn popular. It's a way of accumulating instant cash growth returns on your investment into any one stock. A way to generate income on a regular basis straight into your investment account. Sounds great, right? Well, maybe not necessarily that great, because there is a hidden danger that not many people talk about when it comes to dividend investing. And in this video, we're going to talk about some of the pros, some of the cons, but also the big hidden danger that nobody seems to talk about on YouTube. Now look, if you are a regular returner to the channel, you know the drill. Make sure that like button is turned blue. It would greatly help me out with the YouTube algorithm, and it would also appease the stock market gods. And one last thing before we crack on, if you want to sign up with eToro on the pinned comment, sign up, deposit, make a trade, and you do go ahead and get lifetime access to the LWT eToro chat room. And in all honesty, eToro is not a bad broker to collect dividends from if that's what you're looking for. Now I'm not going to give a deep dive into what a dividend actually is, but in very simple terms, it's where a company makes some profit, and what they do is they pay some of that profit back to its investors in a form of a dividend, meaning that the investor gets paid a small amount of cash back into their account in a form of a dividend. The investor can then take the cash out and go and spend it on Pokemon cards or do whatever they want to do. Now these dividends can be paid monthly, quarterly, semi-annually, and in some cases even annually. It all depends on the company and the way it's set up. And some companies don't even pay you a dividend at all. Now, before we look at the cons and the big hidden danger with dividend investing, let's look at why people do love it. And trust me, I'm one of the people who do love dividends, but I like them for a reason, which I'll also disclose at the end of this video. Now, the main advantage to dividends is exactly what they are. It's a way of you receiving cash back and getting an instant return on your investment. And what person doesn't like receiving cash from their investment on a regular basis? It makes absolute perfect sense because we're all human. The name of the game is to get more cash paid into your account on a regular basis. That is the goal of literally every person and every investor on planet Earth. And I also fall into that category. I mean, look at this. This month alone, I'm expected to receive around about $1,600 from dividends alone. And don't get me wrong, it's not there to brag. It's just showing you that if you do pile up your investments, you can get a decent chunk of change in a form of a dividend when you do it correctly. Now, we obviously don't get $1,600 every single month, as you can see, but it's pretty obvious when this month, this quarter does come around, I obviously take my wife out for a nice seafood dinner. Dividends have become the superhero for many novice investors and also people who just don't have the time to actively manage their account. It's become the superhero of the internet in terms of finance as well, because everybody thinks you buy a stock, you get the dividend, and you reinvest the dividend, and then you retire happily ever after, a lot richer. But really, dividends might not be the superhero you're thinking of. In fact, dividend stocks could actually be a supervillain hiding in plain sight. And what do I mean by hiding? Well, I could sit here and say a lot of companies have a lot more risk than others, and over the last 2 years it's become apparent that a lot of companies do in fact cancel their dividend or even slash it. If you look at GM, Rolls-Royce, BP, Exxon, Chevron, they've all cut their dividend at some point, and in some cases completely cancelled it altogether. Your dividends are not guaranteed, but that is obvious common knowledge. Anyone can go and find it out. That's not hiding in plain sight. We also have some companies that simply do not have enough cash flow again in the last 2 years, but continue to pay dividends. And the way they have been doing this is by diluting the shareholders, offering more shares to the market so that they can use this cash to pay out their dividend and keep their name as a dividend aristocrat, which in theory is basically getting you to pay another investor and another investor to pay you. It doesn't make sense. But again, this is not hidden, it's pretty damn open knowledge. We could also talk about the taxes on dividend, which sort of seems to get missed a lot here on YouTube as well, because as soon as your dividends come into your account, it should be declared, and depending on your situation, you should have to pay taxes. Whereas if you actually held a stock that didn't pay dividends, you only need to declare it when you sell it in most cases. But again, that's not hidden. What am I getting on at here? The hidden danger of people investing into dividend stocks is getting less than 10% a year. Now hear me out here, because I know it's probably not going to register with a lot of people right away. The average return of the S&P 500 every single year since its inception is over 10% a year. So unless you're getting a dividend from a stable company that equates to more than 10% a year, you're literally wasting your time. And let me put this with a simple example. Let's talk about a dividend aristocrat, one of the best dividend payers of all time, a Warren Buffett favorite, and that is Coca-Cola. If we look at Coca-Cola, they pay you, at the recording of this video, a 3.7% dividend. And this 3.7% dividend equates to about $8.86 billion US per year, which is a hefty amount of money Coca-Cola has to pay out for actual dividends to investors of the company. But if we look at the free cash flow over the trailing 12 months of Coca-Cola, it's $9.86 billion a year, meaning that after they pay their dividend, in theory, they only have $1 billion left over, which might sound good to the novice investor right now because they've got enough money to pay their dividend. But wait, what about this 10% a year? Because right now you've got your 3.7%, what about the growth of the company? Now, this is where it gets sort of nitty-gritty, because now if you think about it, Coca-Cola only have $1 billion left over in free cash to source new revenue streams, to invest in their company, buy back shares, or grow their brand in new ways. Now, Coca-Cola, of course, is a unique exception because it's a dividend aristocrat, and its sole purpose in existence is to pay back investors in dividends. But if Coca-Cola did not have the year it's just had and stayed pretty much flat, well then you've lost out on the market and just wasted your time and money. So you need to find a company that has growth potential. You need to find a company that is not only gonna pay you a dividend, but also can make up the difference to that 10% in terms of free cash flow, revenue growth, and has a lot of options in the future. In my opinion, this is why I tend to sort of stay away from Coca-Cola, because 3.7% is great, but unless the company is growing fast to make up the other 6.3% needed to match the SPY or the S&P 500, then we're just wasting everybody's time. If Coca-Cola cannot invest its leftover cash flow after it's paid its dividend into new revenue streams, to me that doesn't add up in ways the company can grow. And I'm not hating on Coca-Cola here because I actually think the company's quite good. But if you go on the last 12 months, they have made over this 6.3% deficit in terms of the stock price as well. So if you bought it 12 months ago, you've actually made more than that 10% as well. But again, if you compare that to the SPY has done like 35% in that same time. So you've got to ask yourself the simple question, was the 3.7% cash back into your account actually worth it? Now again, there is a place for dividends. I actually love receiving dividends, but it is not the main reason I pick stocks. And I feel a lot of new investors are picking companies. I see it on my YouTube videos. They are picking these companies or even REITs for their dividend without realizing they need to make even more than the dividend just to break even in terms of buying the S&P 500 every single month. I think a lot of people misunderstand what a dividend actually is. It's a bonus, but you shouldn't be buying a company just because of its dividend. Now, to summarize the point I really want to make here is that dividends are in fact great, but you shouldn't be buying a company just because of its dividend. You should be still looking at the free cash flow, the way the company can go up. Is the company good value? And if it pays you a dividend and can afford to pay that and still grow the company, then yeah, probably it's worth a better look and maybe a good investment. But if you're buying a company just because it pays maybe, I don't know, an 8% dividend, you've got to ask yourself, will this company grow by 2% a year? Because if not, you're better off just buying the S&P 500 and keep buying it over the long term. I feel like right now the whole craze on YouTube with dividends is all about buying dividends and reinvesting them, and they're missing the whole point that dividends are just a bonus and a reward for loyal investors. You should not be focusing on dividends first. You should be looking at it as a bonus towards the end. In honesty, I don't really care that much if a company pays a good dividend. If it does, of course, it helps me make the decision. But if it does pay a dividend or it doesn't, really doesn't affect whether I'm going to buy the stock or not. It's all about growth, because if the company cannot do 10% a year, in my opinion, over the period of time that I'm looking at holding it, then I'm just not interested in that company. Right now, I feel like there's a lot of companies who are really pushing the boat out in their free cash flows to make sure dividends are paid. They're even offering shares and diluting investors to make sure they're paid, when reality is just getting 5% a year is just not good enough. What are your thoughts? I'd love to know your thoughts down in the comments. If you're new here, we usually do a thing called a code word, but we're not going to do that here. If you've made it this far in the video, firstly, thank you and congratulations. You get to put down your favorite dividend stock down in the comments. Tickle that like button until it turns blue. And if you want to join the chat room and get some exclusive perks, check out Patreon down in the description. That's it from me. Take care. God bless. Peace.